Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Friday, September 2nd, 2022. I got some posts out to you this morning and then stepped away from my desk. Had our son surprised us driving in from college. I mentioned few weeks back we dropped him off. He's a freshman and came home for the long weekend, so spending some time with him. But quite some movement today. I noticed earlier, checking on my phone, saw a headline, a couple of headlines that I think caused this pretty sharp pullback. The first one that came in today, if you're not familiar, the journal sent out a news alert. G7 rolled out a plan to cap the price of Russian oil, and the way that's going to work, I don't know the details. The fine print hasn't been hammered out, but and I'm going from memory. I read it a few hours earlier. I think it was over 90%, if I'm not mistaken, of all ships transporting Russian oil and gas are insured by a single entity or group of insurance carriers out of the UK. And so by canceling or and refusing to insure those ships, or you're not going to want to transport large amounts of gas and oil. So that's obviously Putin's not going to like that, and he didn't. And as expected, in typical Putin fashion, he fired back. Remember, I've been talking about the Nord 2 pipeline was under shutdown for quote unquote routine maintenance. They keep doing that. It was at 20% capacity before that. They're trying to show the West that, hey, don't mess with us. Let us do our thing in Ukraine, or we're going to choke off, Europe from their preciously needed natural gas. Anywho, so Russia fired right back, saying they're not going to open the pipeline on Saturday as they had said they would, citing mechanical problems. Obviously, that's a lie, but they've never had an issue lying there about that. So that was obviously a direct response to the G7's threat to try to cap the price of Russian gas and oil. Because remember, a few weeks back, I've said it a couple times that Putin's been laughing the whole way through this thing, because we tried to we crack down on some sanctions, but it has not prevented him from selling gas and oil. There's plenty of countries out there that are glad and happy to buy Russian oil and gas. So the Saudis and Russia, this has been a huge boon to them, these spike and surge in natural gas and oil prices. So that's what the West is trying to control. They realize these sanctions really aren't doing much because Putin's still in control. Anyway, so that knocked us down. I believe that had a big part to do with it. I just want to give you the technicals, and once again a reminder that it is a 3-day weekend coming up. So if you're long or short, this market's going to probably gap up one way or another. We're still off those lows, but we had a really healthy pullback, more so than you would normally expect after a breakout. I gave you this 5-minute chart of QQQ in the comments section below one of this morning's posts, and in that you probably noticed I had an uptrend line right there. And so right here at the highs today, I'll show you in a second, that was a perfect tag of some of the early targets on the NASDAQ 100 futures, NQ, and ES. And so a pullback was expected, but this is where normally I would have suspected they would have come in and bought the pullback right there on the uptrend line after that pullback. And they sliced right through it like a hot knife through butter, sliced through this level here. This is a big level as well, 299. Big level. That was support there, big old gap. We gapped above it today, pulled back. That was a buying up this morning. And again, pretty impulsive drop. This is more indicative of bear market action to see a beautiful textbook bull flags on the NASDAQ 100 and the S&P 500 and the Russell 2000. These are the flags on the 60-minute chart. Remember yesterday I gave you both 120-minute and 60-minute charts. So we're looking, this one's an hourly, aka 60-minute chart. And on that one I had targets at 12,277, which was hit already, yesterday. We consolidated on that one, then popped up this morning, almost perfect tag of my 12,473 level. And again, as expected, a reaction, but quite a bit more than you would expect on the heels of such a beautiful textbook bullish falling wedge and also major trend line support. Remember, we also had the uptrend line on ES right there, the NASDAQ 100 futures. I'm sorry, the S&P 500 futures. So remember, bigger picture, we're in a bear market, and it is possible that this whole thing, it's been a nice pop off the lows yesterday, but that may be the end of the run. We'll see, and I'll tell you. Remember, again, here, let me show you on ES. We're still above. This is ES. Here's that primary uptrend line off the lows, mid-June lows. That's what we hit yesterday. That's where we bounced. We're still above it, and nice price support here, 39.11 plus Fibonacci retracement levels that I pointed out yesterday. So as of now, support is support, and support is support until unless broken. So we're either going to hold it and maybe continue on up. Now you need to take out that first target there, that 40 or second target, or whatever it was, 40, 15, 50 on ES that was hit earlier, and then that would take us, if taken out, that will most likely carry us up to these next levels, 40.76 and or 41.11. But the way this works too, guys, I know right now it looks like that trend line comes in, and it does at this point in time with 40.11. But remember, trend lines are dynamic. Price resistance levels are static, meaning trend lines every day comes in a lower and lower level. So the way this works, if, and I'll tell you right now, I have a lot less confidence looking at the impulsive nature of that rejection, even though it was headline induced, doesn't matter. It's what happens in bear markets. I have a lot less confidence now than I did earlier today that we may go on to hit those. And so I already told you my thoughts about going home heavy long over the weekend. Not favorable in my opinion. Not in a bear market. I don't care how good these wedges look. Yeah, so what I was trying to show you is if we zigzag, if we happen to hold these levels and work our way up there, by the time that trend line comes in, we could be way over, that trend line's going to come in lower and lower and lower and lower, and maybe we zigzag like this. But I tell you, I wouldn't put as high odds on it right now as I did last week, or I'm sorry, earlier today, because of the fact, here, I'll show you, this is what I talked about before. Big picture. Oh, never, ever, ever forget the big picture. We have a lot of trend indicators bearish. We're below both the 200-day exponential and simple moving averages after getting rejected off those. Hit by max bounce target zone on the upside off T3. That's where we reversed, covered all shorts, went long, and that's where I figured this rally would carry. So there's very, very much the possibility that we've started the next leg down, and as I said, just don't underestimate how impulsive, how relentless the selling can be in a bear market. And again, the fact that they've sold pretty hard into the follow-through to yesterday's breakout so far today is sort of somewhat of a signature move of a bear market. And if the breakout fails completely, which is going to be, again, a breakout, a fallback below those levels, yesterday's lows, pretty much, keep it that simple, then yeah, that's going to be a very, very bearish technical event. So let me just go here, 3-month hourly. There it is. There's the alternative trend line right here. That was on, remember we hit the primary trend line on ES, but I had an alternative trend line on NQ that comes off these lows right here. Lots of reactions there, and that's what we hit. So that's it. Let's see what else I wanted. Oh, and then natural gas, of course. We'll talk about that because that's what's moving today and could continue to move. So, well, we now know, told you before, we were going to have to wait until over the weekend to see if they turn the pipeline on. And now we know that they said they're not going to. But who knows? That's just Putin, and that's the games, politicians play. If the G7 cows down, which I don't think they would so quickly about the threats to try to cap the price of Russian oil, yeah, of course, he would turn the gas back on. But we're playing a high-level political games here, and here's the bottom line: we broke down below the support level today, triggering the next sell signal. We were halfway there, and then that news hit. So of course that's going to be bullish, and so it foiled. We were headed right down towards that next target at 846, and then that news hit. But from a technical perspective, look what's going on. And remember, we're trading. This is Henry Hub. I don't trade Russian or European gas. I trade U.S. gas, Henry, that settles with the Henry Hub complex. That's what these futures are. And that broke down, and it back tested. Remember the level I told you was 8,929 that we needed to take out on a solid 60-minute close, and we did. So from a technical perspective, This is still, an active short trade. We had our first sell signal there, and today our second sell signal. So we can try to guess what's going to happen. Obviously, things are heating up between Russia and the West, but this we could see this continue to fall next week. Well, almost close to taking out those divergences that had formed after. So I'll still maintain these targets on natural gas. The chart to me is quite bearish, but I cannot rule out. Again, it's just like the equity markets. You don't take a heavy position right now in any of this stuff that is so subject to geopolitical risk. Because the charts are to me the most accurate indicator. But when the fundamentals are very strong and you're in a rapidly shifting environment, news-driven environment like this, yeah, there are times where the charts cannot always predict what's going to happen fundamentally, especially when things are, happening like they are right now with Russia and everything else. So that's it. And the other thing, I just still Treasury still look good. No change there. Go to ZF. That was a 5-year. Remember, I is the ETF for that. You had that price channel here on this hourly chart. Breakout and a back test today. So there's an objective long entry, and I think that we'll probably see a risk on flight. Yes, Treasury's prices, and I've talked about it, have been very, very much distorted by the Fed with first quantitative easing, now quantitative tightening. And the Fed is an unnatural buyer. Back in the day, for throughout history, pretty much, and you track Treasury prices, it's just the like anything else when you're charting, it's where buyers and sellers are coming together, natural market forces, and that's why technical analysis works. In other words, institutions or bond traders will buy bonds when they think rates are going to go down for whatever reason, inflationary forces. Or they'll buy bonds, institutions, to hedge risk if they think there's going to be a stock market correction. But the Fed was buying bonds because they had a scheduled bond buying program during quantitative easing, and now they're in quantitative tightening. They're unloading those positions, and they may do it, at random. They're not doing it to hedge risk or to try to game interest rates or whatever. So I just want to say that's right now the charts look good there, and all we can do is take it on face value. And there has been, as I talked to you, it's traded well off the technicals, and maybe part of that is the Fed is one of the buyers, even if they're an unnatural buyer. They're a buyer in here, and it's been reflected so far in prices. So that's it. I just want to say I still like the Treasury longs, and then CB or TLT, those are your long bond, and that's still carrying up. These are still your first target zone. And right there, I'll probably get a reaction on the initial tag of the channel, pull back, and then a next buy signal coming, a break above 135, 207 right there. All right. Okay, so that's it. I really just wanted to update the markets and what's going on here with that big fade today. Also, take a look at this 60-minute chart here of QQQ. And remember, we have this trend indicator. We've got a couple lines here. The purple line at about negative -0.5, and then a white line here, and then there's the zero line. And depending on different points in time, sometimes the zero line defines a trend, but as of now, this trend indicator is still bearish, it's still below that purple line. So like I said, this could be, I'm very much open to the fact that this little pop, as good as it looked and still does, could be the end of the rally here. It's a crapshoot over the weekend, so I'll just leave it at that. And just don't think the risk reward, as beautiful as that breakout was, the longer term charts, being in a bear market, everything going on, I don't think the risk reward to going home aggressively long is very good right now. All right, we'll pick it up. I'll do an end of day if anything else happens. Otherwise, remember, 3-day weekend, so I'll pick things up on Monday. We'll see how the futures trade. They usually have, they do trade on the holiday sessions usually, but a abbreviated trading session, but at least we'll get an idea what's going on there. This has been Randy Finney with Right Side of the Chart. Have a great weekend.